Are positions telling us that the top is in the index? Well, that may be the case, and here's exactly why. The SPX position is built from something we call short skew. As a market maker, short skew means that we're short puts and we're long calls to you, the customer. Why is this? Very basic. Because you, the customer, are generally going to own stocks. And the whole purpose of options in the first place was to be able to hedge those stocks. So you own the equities, you go buy puts, and you sell us calls to finance your hedge. This behavior is so common that some of the biggest positions in the market are literally set up to do that for you, like the JP Morgan put spread collar, for example, where in one fell swoop, you buy the ETF and you are delivered a hedge structure. For the market, though, this is important. And for our hedging, this is important. This drives the market's behavior. In a normal market, this position where we're short downside options creates downside negative gamma. Of course, all that means is that when we go lower, the market's kind of erratic. It's volatile. We have the opposite influence when the market rallies because you've sold us call options. We own what we call gamma, which helps stabilize the market. These positions in a normal market create an upward trend and behavior that generally looks like this. Now, if you can see that scribble on the board, all this is trying to convey is that when we have a dip, when there is a sell-off, it's usually a little bit erratic. We get volatility going up in two ways, right? We get option prices going up, that is vol up. We also get realized volatility going up. It's just more erratic. That's because we on the other side of your position are hedging the negative gamma in that range. But these dips usually resolve, right? Because after all, most customers are hedged. They don't need to sell a ton of equities. They're safe. And so they can just ride this out. And eventually time allows the market to resume its upward trend and it flattens out. Why does it flatten out? For the exact opposite reason that it doesn't have this nature down here. The market's more stable when we have more positive gamma. So this position, again, is called skew. Skew is something that you can track on your own. In fact, the chart that you're going to see in just a moment is 3-month normalized skew. What this is a measure of is literally the relative pricing between put options and call options, each around 25 delta. The reason this is so important is because this measurement, the focus is on the specific types of options that cause the market to correlate inversely with volatility. Now, this skew measure is important to follow because it literally shines a spotlight on the two types of options in our position as market makers where the hedging drives the market's trend. And right now, this measure is low. When I say low, what I mean is the difference between put option pricing and call option pricing is historically low. You can see it on the chart yourself. So if a healthy skew level gives us a normal uptrending market, what does it mean when skew is as low as it is right now on the chart? Well, it would be not normal. Long skew is very simply the opposite of what we usually have in the market. Now remember what I said before. The reason we typically have this slow upward trending market is very basic because customers generally own stocks. Customers usually buy puts to hedge these stocks and they sell calls to finance the override. Now think about that trade setup. When that trade is initiated, if you're buying stocks and buying puts and selling calls, someone on the other side has to sell you puts and buy calls. That would be me. And as a market maker, what I do when I have this position, I sell futures against both sides of your trade. But in this range, with this position, this is no longer true. Customers are not well hedged. They may or may not own stock. They might need to chase stock in this range. And instead of buying the stock, it seems like lately the data has shown us that they're not selling calls. They are buying calls. So instead of a structural position in the market built by your hedge position and my need to buy back the futures that I've sold against your position, we have the opposite, which means instead of that upward trending bias, that slow passage of time that creates the drift, we have a market that becomes toppish by nature. Because in this type of market, we can get erratic moves, not to the downside like the other panel, but to the upside. But they tend to fade. And why does this happen here? Why is it erratic on the upside? Well, it's the same reason it was erratic on the downside before, because these key levels, when we reach them, we're short gamma as market makers. And so we're creating a lot of noise as we have to buy high and sell lower just to keep up and make sure our delta is neutral. The problem with this is as long as the options are out of the money, there is a need for these futures to eventually be sold, right? This move here forces us to buy futures on the way up to hedge the options that we're short. But if we don't cross over them, don't pass them, then what happens is as time passes and as vol comes down, which it eventually will, we get the opposite. We start to have to sell futures. And the same thing that forced us to chase the market while anybody else is buying on the way up actually re-engages the opposite direction and creates a passive selling that winds up just sending the market retracing its move. So when you see positions like this, you have to be careful because the top is generally not stable. This top creates an inverse spot vol correlation. Vol goes up as the market goes up. Again, not normal. You're going to see this when skew is very low. You're going to see it in the way volatility behaves as the market goes up. It's non-traditional. It's a warning sign. One of two things usually has to happen for this to resolve. Either the market pulls back or positioning has to be just dragged up and reset, meaning customers have to come back and buy stock. They have to re-hedge their positions and buy put options that are nearer the money, and they have to start selling calls again and taking market makers out of the position that creates this exact dynamic for the market to resume its safe uptrend. Now, this dynamic you can see ahead of time with VS3D. Now, I know we talk about gamma and charm and zero-day behavior all the time, but these influences that drive longer-term trends and regimes, they are longer dated. And in VS3D, you have to look at two things, VANA and the position grid, to evaluate what positions look like and the expirations built up 1 month out, 2 months out, 3 months out. Once you do that, you start to see that these moves and the behavior and volatility are in fact very predictable. And if you want to see the positions and the influences yourself, you can sign up to a free 7-day trial to VS3D. There's a link in the description.